Hello and welcome to Your Property Empire. I'm Chris Gray. Tonight we've got a special show where we take a look at property depreciation and how it will affect the cash flow of your properties. Now, research shows that 80% of property investors are underclaiming their depreciation entitlements. Not maximising your depreciation claim could cost you thousands of dollars. So joining me tonight is Bradley Beer from BMT Tax Depreciation. Welcome to the show.
Thanks, Chris. Great.
And thanks for a special one, because a lot of people you assume that they know all these things about properties, but suddenly you then find depreciation. They say, what's that? So maybe it's probably a good start to tell us what depreciation is.
Yeah, look, I get surprised every day because it actually makes such a big difference. And people still that I speak to as investors every day go, what is this? What's it about? And they've already got these properties, so they've crunched no numbers. But what it is effectively is a building is getting older and wearing out. Therefore, the building itself and things within it wear out over time, and the tax office says, let's claim part of the cost of those things each year as a deduction. And we go and work out how much that is.
And so it's really, say if the property wears out and you spend 100 grand renovating it in, say, 10 years' time, they say, well, rather than having one massive lump coming out in 10 years' time, let's call it 10 grand a year or whatever the number is to spread it over the life of those carpets or kitchens or whatever.
Yeah, and different things in the property have different rates, but funnily enough, carpets 10 years, well guessed. So different things claim over a different period of time, but it's being a non-cash deduction, it just helps to make a big difference. And it's kind of like, we all want to say our property appreciates, which it does, generally, providing you get the right one, but the building itself is still one day going to wear out.
Yeah. So do you want to explain to the viewers, you mentioned it's non-cash, so it's really a bookkeeping entry. Do you want to tell people exactly kind of how that works? Yeah,
definitely. Chris, the fact that there's a lot of expenses in relation to your property that you get to make a claim for, but most of them you actually pay for. Depreciation is related to the fact that, it's getting older, it's wearing out, so we're claiming part of the cost of construction. We're not claiming something that we paid out each month or year or week. We're just going, look, one day it's going to fall over, well, maybe not fall over, but one day it has a life, an effective life. The carpet's going to wear out, and we look at the cost or value of these things at the start and make a deduction that relates to that. Bit kind of like your car, except your car actually does depreciate in value as well.
Yeah. So we'll actually pull up an example on the screen, and obviously something that's brand new is going to have more depreciation than something that's old.
Yeah, definitely. New properties, and that's largely because they cost more to build, and it has a relationship to the construction cost. So, look, so we take a new house here and have a look at it, and what we've got is, something with a purchase price of about $550,000. Our first year claim on something like that, we'd expect to be about $14,500. So that's a fairly, substantial claim, 14.5 grand. But now, depending on your tax bracket, we'll demonstrate how much you will get back in the end of that financial year. Now, it goes into account with the rest of your numbers, and effectively you get this back at your marginal tax rate. Most investors are on that 37% tax rate, so that means about $5,365 back in your pocket, either at the end of the year or on the way through the year, depending how you do your taxes. So it makes a fair difference to the actual cost of owning that property throughout the course of the year.
Because let's just say, for example, you've got rent coming in of, say, $30,000 a year, and just let's say the expenses were $30,000, so you've broken even, so you've got no tax to pay. Effectively, what this means is the tax man's saying you've actually lost $15,000 because your property's gone down in value, and so you've lost 15 grand, so you might get 5 grand back.
Yeah, basically, if that's the way the numbers work out, yeah. And whether you make money out of the rent and whatever it looks like that way, but yeah, being neutral like that, it goes, well, look, now I just get to make this other deduction because the building's getting old and wearing out.
And so if you made a profit, then maybe it takes you down to zero, and if you've made a loss, then maybe you made a bigger loss, so again, you got some cash back to help cash flow it.
Yeah, most definitely.
So,
yeah.
Pretty simple. So when can people do it? Like, if they've got a brand new house or a second-hand house, can they get depreciation schedules done whenever?
Well, you can get them done whenever, but effectively the time that before you buy it, you really should, there's a lot of things to consider, and depreciation's just one of those.
So it should actually be part of the investment criteria, almost, to take it into consideration rather than doing it post the event?
Well, doing it post the event is when you're actually going to get these numbers together, but helping and working out what is it actually going to cost me to own this property before you go ahead and buy it would actually be a good thing to do. So getting an indication of those numbers prior to actually making this purchase decision is something that you can do. And we've got calculators valuators, or we talk to you about your property and have a look at the photos and go, we think it'll be roughly this much money, so that when you're actually crunching those numbers, as part of that decision, you can go, well, look, I know that depreciation is probably going to be this, and you'd always be a little bit conservative with that number until we actually go out and do the job. But we've done a lot of them, so we've seen something similar in the past, and you got some indication of what what your cash flow position will be on the property.
Now, is it always going to be worth it? So, I mean, obviously there's a cost of running the reports and things like that, and so some people may say, oh, well, is it worth it for me, or is it a guarantee that you're always going to get more money back?
Well, there's a lot of things that affect how much depreciation you are going to be able to claim, and like we'll be able to give an idea of what sort of deductions are going to be related to your property before we go ahead and do anything. So it doesn't cost you anything.
You can ring up and say, look, I bought a property, it's roughly 40 years old, and this is how much I paid.
Yes, and with a couple of photos, and we'll ask you a few questions about it. Like, you know, if things are really old, then there's not going to be much claim left on them. If your carpet's from 1927, it's worth nothing.
Yeah.
But always ring and ask the question, and we'll tell you, look, we think it's worth it. And if we can't find deductions, we don't do it. And like we sort of guarantee, if we don't get, you know, deductions that are twice what the fee is in the first full year, then you can have the money back. We'll ask you a few questions.
So it's a no-brainer. Exactly. But it's one of those things, you've got nothing to lose, so you may as well do it.
Yeah, most definitely. And you should be able to have that sort of guarantee from anyone like us that's going to do that.
Yeah. Houses, units, much of a difference?
Look, it relates to construction cost and the value of items. Now, when you buy a house, you're actually buying a bit more land than you are with a unit. So when you buy a unit, there's a couple of things. Firstly, a unit has a lot of common areas which you usually get to claim in most states, and a lot of those things are quite expensive, like lifts and underground car parks, and so sometimes the dollars and deductions on those things are actually a little bit higher for two reasons. One, you've got these common areas, and two, out of your purchase price, you're probably buying more construction costs because you're not buying so much land. Hence, you end up with a bit more deduction on a unit if it's purchased at the same price. Sometimes, not always, but...
And sometimes there's a danger sign you can hear in there. You can say some investors saying, hey, I'll get 20 or 30 grand depreciation. That could actually be a bad sign that you've got lots of expenses, lifts and pulls, that, sure, you're getting depreciation back, but you're paying for it.
That's exactly right. You've got strata fees and a house doesn't. There's both ways on that argument. You know, yes, a depreciation will be a little bit high, but there's things that are depreciating that you're going to have to fix one day as well, or someone is.
Yeah. So look, the biggest takeaway from the first session here is, look, you've got nothing to lose by it, so if you haven't got a depreciation schedule, well worth looking at. Anyway, after the break, we'll take a closer look at how depreciation works for older properties.
For the life of the car you love, we'll replace it with a brand new one if yours is ever written off. Just take out GIO Platinum Car Insurance within a year of buying it new. GIO, it's a trust thing.
Help you be retirement ready? CommBank can. Book your free initial consultation with a Commonwealth financial planner today.
Hey! What I like about you, you hold me tight. Keep on whispering in my ear. Tell me all the things that I want to hear, 'cause it's true. That's what I like about you. That's what I like about you. That's what I like about you. Hey!
You need a website. Why not do it yourself? Drag and drop anything you want, anywhere you want it. Create your stunning website today. Go to Wix.com. It's easy and free.
When you wish upon a star, makes no difference who you are. Anything your heart desires will come to you.
Introducing Foxtel Movies Disney, a magical new channel for our premium movies and drama customers.
This Easter, Australia's Public Affairs channel takes you live to the Vatican as billions share the deep meaning Easter holds for their faith. Live from 5 a.m. Saturday, from the historic Colosseum through the streets of Rome to Palatine Hill, the Pope leads the historic Way of the Cross. Easter Sunday from 6 p.m, Pope Francis leads the celebrations of the Easter Holy Mass, live from St Peter's Square. That's this Easter weekend on Australia's Public Affairs channel.
Welcome back to the show. Now tonight we've got a very special show on depreciation and we're joined by Bradley Beer from BMT Tax Depreciation. Welcome back to the show. A lot of people say, oh, my accountant does that, I don't need to go to a quantity surveyor. What's the answer to that one?
Look, Chris, that's a question I hear every single day. It's either doesn't my accountant do it or I've got a good accountant though. Well, why do I need you? Now the first part of that is that we work alongside the accountant. I'm not fighting with the accountant in any way. They're my friends. Most of the jobs that we do are referred by the accountant because often the investor's not maybe as educated about depreciation, for example, as they could be. They buy the property, then they go off to their accountant next year and he says, where's your depreciation schedule? You say, what's one of those? Now, there's sort of two reasons. One is that it's about compliance and making sure that it's based on a number that the tax office will accept. Now, traditionally, what I am is a quantity surveyor, which is someone who measures and estimates the construction costs of buildings. You know, I've done a building degree and some other things that mean I'm a quantity surveyor. The tax office, this claim relates to construction costs, so the tax office puts a rule out that says we'll accept the estimate done by a relevant professional, such as a quantity surveyor, if we don't have all the costs available. So it's about compliance first, and we kind of take the risk away from the accountant and from you as the investor or whoever the investor is to make sure that if the ATO checks it out, they go, yes, quantity surveyor's had a look at it. It's also about knowing knowing the rules, not just being the quantity surveyor, but knowing what we can and can't claim, and all the rules about the actual property. See, the accountant doesn't go and visit the property. We actually do an inspection of the property so we can identify these things and put values on these things, and we've got photographic evidence of everything that's in the property, so that's how we come up with these numbers. So, you know, it's about compliance and about getting everything you can out of it as well.
And again, because some people might argue, or the accountant might say, oh, look, an hour of my time I can do it, and so you'll save some money, it'll only cost you a couple $100. But if they're only getting 5 or 10 grand depreciation and you're getting 15, it's better to pay the full price. It's a false economy at times using the accountant.
Well, you know, once again, they're my friends, of course, but...
Because they refer you business.
They refer us to business, yeah. But most these days, and they're much better than they have. Like, I've, you know, been BMT 16 years, and back then, at the start, it was a bit harder. Now they understand a little bit better than they did in the past, and they really know that a guess by them firstly is something that probably won't stack if the client gets an audit. So secondly, they'll make a conservative guess because they didn't go out and find everything in the property either. So we usually get 1.5 to twice as much as the accountant guesses anyway, usually by actually being thorough.
Because you mentioned about actually visiting the property. So what are you doing when you physically go there?
So we're going out, you know, through the property, and we're measuring up the property because we want to estimate the construction cost. So we need to have a look at the type of construction, and then there's a lot of different items in there that we need to put some sort of value on for the purpose of depreciation. And we're actually eyeballing these things and going, you know what, that's a pretty expensive stove, or no, it's a basic stove, and we're putting a value on accordingly. And then, you know, so we do a lot of measurements, we take a lot of photos, we have a look at the quality of the things in the property so we can actually put a real estimate on the value of the property. And
so when you're renovating, we actually need you guys out before, really, to say, well, what stuff are we throwing in the skip?
Well, yes, a whole new ball game of if you're renovating, you really should have depreciation looked at first. And we kind of call that scrapping. It's not really the tax office word, but it's just easy to understand. You're scrapping things. They had some value. Now, providing you've been using it for income-producing purposes before, as it was an investment property, then you should have a look at what was there because there's some depreciation that relates to that. But then when you throw them away, rather than continuing to depreciate them, it's an instant claim in that year for whatever's left.
Yeah, so because you're writing it off.
You're writing it off, and then you can start claiming the new things in the future.
And then effectively you could get the builder's invoice and give it to you to say, right, this is the stuff I'm scrapping, and then this is the new stuff that's going in.
Yeah, look, the things from scrapping we've already seen before, but then the new things that go in we can usually put in there because we've got most of the costs then available.
Yeah. Now, let's pull up another picture of a house, and we'll look at the older properties. So older properties potentially don't get as much depreciation?
That's right. So the second most common question after the accountant is the fact that they think old property doesn't get depreciation. We've got an old house here, purchased for $480,000. It's got a depreciation the first full year, $5,200. Nothing like the $14,500 from previous examples, but it still means, nearly about $1,900 in cash back in that first financial year.
You'll pay your land tax.
Well, your land tax or something, And also, I suppose, the thing is there's not as much in total because there's a lot of things that you're not going to claim. You don't get something on the structure of a building that's this old. But old property still gets depreciation, I suppose, is the important thing. It still makes a difference, not as much difference, and it also runs out a little bit faster. So the year 5 and 6 of depreciation looks a lot worse, but there's still some there. It's always asked the question. We'll once again we'll talk to you about the property. We'll talk to you about what sort of deductions might be there, and just make sure it's actually worth you going through this process before we go ahead and do anything.
And then I guess the next obvious one is obviously going to units, and I think we've got a graphic for that we can pull up as well.
Yes, and we've got a unit here that's a little bit less expensive for, $420,000. Its deduction's a little bit higher. Now, it's probably got some common areas, may have had something else done to it that means it's, as I said before, units sometimes get higher depreciation, but that's because you've got sometimes more things to fix later on, obviously. So still $2,200 back in your pocket. There's a little bit more over the total depreciation claim over the life of the property on this one than the house, because we've obviously found a few more things in this property than we did in the house that were there to depreciate, basically. But, units versus houses, depreciation's not a... don't buy a unit or a house because of the difference in depreciation. There's a debate forever about which one's better.
But it's amazing how often that's done, though, because especially when you get developers selling brand new properties, their biggest catch cry is this will only cost you X bucks a week because you're getting so much depreciation back. But really, that's the kind of the accounting thing. That's almost not the last thing you should look at, but it's location and the physical property you're buying and the price you're paying.
Depreciation, like many other things about that decision of buying a particular property, is something that's a bonus, definitely, and you want to maximise the cash flow out of it on the way through. But the fundamental reasons for buying that property are about the cash flow, the future growth, the potential for you to make money out of that property. Depreciation is going to help you on the cash flow on the way through. It should not be the reason for this one or that one. With respect only to if you're looking at two houses next to each other that are 10 years age in difference apart and there's an important date in 1985 that matters, look, the newer one's going to get a bit more depreciation. That's assuming all other eggs are equal, I suppose, in the purchase decision.
And when you're actually doing these reports, what are the percentages of new versus old that you typically deal with?
Yeah, I was actually did this research across all of our jobs recently, and we found that about 60% of the properties that we do are not new, so second hand. So even though depreciation on new properties is sold as the reason, sometimes more than half of the properties we did at BMT were old or second hand. Now, on top of that, there's that special date we talk about in 1985 that makes a fair difference to the amount of claims that sometimes are available, because you don't get the structure prior to then. About 20% of those or 20 or 25% of those were actually pre-1985 constructed properties as well. So a lot of these ones that in the past people thought, oh, too old, can't get anything, we've had a look at that and still they've been worth going ahead after we've spoken to them.
Sounds good. Anyway, time now for a quick break. We'll be back soon and we'll be looking at more ideas around depreciation.
Dog home recipe has been thoughtfully prepared with premium ingredients like free-range chicken, making it a wholesome meal you know they'll love. My Dog, love them back.
The Mazda CX-5 is now so smart, it can help prevent low-speed collisions. And so efficient with Skyactiv technology, it can run a long way between drinks. The smart and agile Mazda CX-5. An SUV, but not as you know it.
This is ex-Navy SEAL Joel Lambert. These are the world's most elite tracking forces.
All assets through the bridge.
Their mission, catch Joel.
I've got Prince here.
He has a few basic tools. They have an arsenal.
They are right on me.
What would you do?
Put in a trap. I'm just wasting time.
The hunt is on.
We've lost them. Again.
All new series, Manhunt, premieres Tuesday night at 7:30, exclusive to Discovery Channel.
I'm chasing Bill Short now. I've been reluctant to bring him onto the show earlier because he really will make mincemeat of you, and I don't want to embarrass you. Mincemeat of you.
I'll be the epitome of courtesy and respect.
Will you really? What's changed?
That's right, thank you. The first compliment.
I think that's fantastic.
Once Bill comes on, of course, there won't be many people watching.
Now, that's unfair. What about John Howard? Why can't we have John Howard?
Of course we'll have John Howard on the program.
I want to have John Howard.
Righto, done.
Done. It's
Like
that
this.
simple, is it? And that's Richo.
And Jones.
Welcome back to the special show on depreciation. Now, Brad, I guess for a lot of people, they might suddenly think, oh, God, I've had a property for 5 or 10 years, I haven't done depreciation. Have I suddenly missed out on 5 or 10 years' worth of stuff? Is there anything you can do to fix it?
Yeah, Chris, it's a bit like if you don't pay your tax, eventually the tax office will find you and they'll make you pay it. They'll probably give you a fine as well because you're supposed to pay it. But the good thing is, as you get educated about certain things like depreciation, you watch something and go, you know what, maybe I'm not doing it properly. There's also kind of rules back the other way that say you can actually amend tax returns. So I've seen this time and time again where you know, you can amend pretty easily up to 2 years of your tax return now. So you come, you see, we have a look and go, look, we look at your property and go, you've had it for 3 years or 5 years or whatever it is. If we did a depreciation schedule on it, the deductions would be roughly X. And you can go back and say, excuse me, Mr. Taxman, last year I didn't claim this $5,000 or $10,000 for a couple of years. Easily they'll pay it back to you. Now, I've seen guys get, you know, one guy got $90,000 back from the tax office that I did some...
He liked us. He paid your bill pretty quickly.
Yeah, he paid the bill pretty quickly. And I've seen numbers of those situations. This also works, though, if you've been estimating or you've put a number in there and it's really only, and you've guessed something and it's 5,000 and you didn't, you know, the accountant guessed or you guessed. If it could be 10,000, you can actually go back and just claim the difference as well. So if there's been a guess made, we can always have a look at that and go, well, it should be around this. Is it worth actually going and amending based on the actual difference in the deductions that have been done?
So again, for a lot of the viewers out there, if their accountants have done it, it's maybe worth saying, look, this is my property, my accountant's guessed it at this rate, is it still worth doing a schedule?
And yeah, and we'll just have a look at that, and the accountant, we'll just talk to the accountant through that process, and you can see how that happens over time. People, they didn't know, they went into the accountant, they've got all their stuff except this number, and he goes, well, look, you know, it's a pretty new house, probably $7,000. Now $7,000 looks okay if you don't know it could be 10, doesn't it? So we just have a look at that, and the accountants, we'll talk and liaise with the accountant on the way through that process where necessary. And I mean, really what's going to happen is they're going to look good to their client later on because they're going to get more tax returns, and that's what your accountant to do your tax for.
And I guess at the same time as kind of looking back at the taxes, say if you bought a property and then the previous owners did a renovation maybe a year or two ago, is that still pretty straightforward for you?
It is, yes. Effectively, we talked about old property still gets depreciation, and some of the reason for that is that if properties have had work done to them, even if the carpet's been replaced at some point, or it's had a new kitchen 3 years ago by someone else, there's still some claims that will relate to that kitchen or that carpet that's been replaced or whatever it is. So when we're asking you ring up and say, Brad, I've got this property that's 100 years old, and is it going to be worth it? We'll ask you a few questions. is everything in there 100 years old? Has someone put a kitchen in there ever, or something like that?
Because I guess for a lot of people, they might not even know that renovations have already taken place, or extensions or something like that.
Well, no, often they don't. So we do a bit of research, we talk to council, but then usually someone will say, well, it's got a new kitchen 3 years ago, and that's part of the selling point, and you go in, you see a new kitchen. There's some claims that relate to that, so we can estimate what those things cost at the time that they were done, and you'll still have some claims related to those things.
Okay, I guess the next most straightforward thing is how do people go and get a depreciation report?
Well, look, that's really easy.
And there's probably a website that we can put up there called bmtqs.com.au that might give a few hints.
That'll be a couple of hints, but it comes down to first looking at, you know, call the Quantity Surveyor, us, or call someone who knows about it and find out, look, is this property going to be worthwhile doing first before you go anywhere? Now, that shouldn't cost you anything. I mean, we've got calculators online and their apps and all that information that you can go and play with it yourself, but it's free as much as you like. But after that, a discussion first, and we'll talk to you about your property. And we go, yeah, well, yes, you're going to get some money.
and again, I guess just like any services that investors are looking at, cheapest isn't always best.
Yeah, that's right. Look, you've got to make sure it's thorough and it gets everything, because, you know, I mean, you should go to site and make sure we get everything.
Wonderful. Thanks for joining us this evening. And thanks for joining us at home. I hope you've enjoyed this special show on property depreciation. Until next week, I'm Chris Gray. Good night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.